balance, which is initial balance minus charges plus capex, this line here, 267, goes to your balance sheet. So property, plant, and equipment is equal to line 276. Okay? Any questions up to now? Almost done. So up to now, let's just recap. We have calculated all the items on the income statement, because we already accounted for the non-cash depreciation all the way to the net income. We have calculated accounts receivable, inventories, property, plant, and equipment, and accounts payable. We need to calculate the other items. In this case, this is a simplified example. We're not making any assumption for other assets or other liabilities. We're assuming this is a flat figure that doesn't grow over time. So we're left with the shareholders' equity and minority interest and the total debt. So the next step, calculating net debt. Pretty much the same as we did for property, plant, and equipment. We'll start with the ending balance for the previous period. In this case, 59.26, right? So line 281. Line 281 comes directly from the balance sheet. Okay? This one here. We come down here to your calculations. This is your debt at the end of the period. And you carry that to the start of the period for your first projected period. What we're gonna do here, and this is where the circular reference is introduced. We have two line items. The first line item is additions. How much debt do we need to add in order to fund the cash deficit, if we had a cash deficit? Or how much debt can we repay if we have a historical? So that's what we're doing here. And depending on which is the case, if we're adding or repaying, then we calculate the ending balance of the debt. So we have the starting balance, addition to payments, ending balance for debt. The ending balance goes back to the balance sheet. So if we go here to the liability side, this one here, line 57, will be equal to this one, this calculation. Okay. Now, this is the tricky part. How do you calculate the addition to repayments? Additions. We have a line here which is line 283. This is the cash surplus or deficit. This is where we calculate whether the business requires more funding or there's excess cash to be distributed. What are we doing? This is directly taken from the cash flow. J307 will be your cash at the end of the period, the previous period. So it's your starting cash. You're starting with that much cash. In this case, 5.128. You will add, and this is this term here, which is highlighted in green. You will add your cash from operation. So your net change in working capital, your net income, and you add back the non-cash items. You deduct the capex because it's a net outflow, and then you also deduct any dividends and add any equity additions. So that figure will be your net cash surplus or deficit. There's an addition term here that you see here, K164 multiplied by K284. K284 is another assumption. This is the minimum cash as a percentage of sales. You never want to operate a company with zero cash balance. It's never a good idea. So you want to keep that cash balance at a minimum. In this case, we're doing it as a function of revenues. But you can do it as a function of maybe total assets. Or you can have a fixed amount. In this case, we're saying 5% of revenue. So, after considering the total cash available, we're deducting that minimum cash that we always want to have available. So that sets the floor. And with that, we have the net surplus or deficit. In this case, the first year of projections, we have a deficit. So, going back to this is the revolver. The revolver line would include 279.3. If it's in and we keep it separate so that it's clear and we know where it's coming from. If it's negative, if there's a cash deficit, then what the formula here says is the negative of minimum between cash surplus or deficit or zero. So in this case, if we have a cash surplus and the figure is positive, the figure here, the minimum of that will be zero. So you won't add more debt to the balance sheet. Okay? In the other case, we're doing the opposite. We're saying if we have a surplus and we can pay down debt, then we'll pay down debt. Otherwise, it will be zero. Just to make sure that I'm highlighting, it's just for the modeling, for the person that is modeling, to highlight, because this is a key line item. This is the line item that will determine your financing needs. So you're making all these assumptions in terms of how you're going to grow, your margins, what you need to invest. But in the end, you need to figure out whether you're going to need financing or you're going to have excess cash to distribute as dividends, for instance, or to expand your business and do more capex through acquisitions. So that's why it's highlighted in red in my knowledge. So because the formula already takes care of whether it's an addition or a repayment, I can directly add the three terms and calculate the ending balance. And this line here also is where the cash flow balances with the balance sheet. Finally, if we go back to the balance sheet, to the liability side, in my balance sheet, this will be equal to the ending balance, right? But my income statement also reflects financing costs. So if I go back to my income statement, line 211, this is my interest expense. This is how much money I'm paying in banks or bonds or whatever. In this case, it's just one sum. We're simplifying it and just assuming one single thing. So in my projections, I use that figure, that base, 6713, multiplied by the interest rate. In this case, my interest rate is in cell U211. You can see it here. So the assumption here is that the cost of debt is 7%. And that is what is reflected in my interest expense. And it runs through my interest. So if I have more debt, I pay more interest. If I pay down debt, I have a low debt balance, I pay less interest. There's more net income available to me. So that's how we calculate, or that's where you use the recurring formula. And by the way, if you go to your file tab in Excel, go to options. This is part of the initial setting. Sorry, I'm used to doing this, so I forget the basic stuff. This is the first step. You go to Excel options, formulas. You need to enable iterative calculation. 100 is fine. And I usually do this manually. So every time you change a calculation, Excel will not refresh automatically, but you will have to press F9 to refresh and to see the changes in the calculation. So those two are basic settings, manual and iterative. Okay. And with that, the financial modeling is now complete. Now you can start playing around with your assumptions and with your sensitivity analysis. We have a couple of things that I still want to show you. How much time do you have? Is it supposed to be here until what? Until one? Are you guys okay or do you need a break?
Let's just go. If it's just 24 more minutes, let's just go through.
Okay. Very well. So, two or three things that I want to show. Number one, once that you have your financial projections and your financial model working, you can start playing around with your assumptions. So for instance, let's make different assumptions in terms of revenue growth. So we're going to say that the petrochemicals will be growing a negative 5% in 2015 volumes. Okay? I will not refresh so that we can look the change at the end when we do all the changes. We'll change from plus I think 5 to minus 5. Then we're going to change, let's say, the pricing for auto parts will be negative, minus 3%. And let's say all the other divisions are stable, and we're going to keep those assumptions. And now our cash costs will be higher in the case of petrochemical because we have a decrease in volumes, so we have lower operating leverage. So let's say it will be 82%. And also the auto parts division, because we're having a lower average selling price, lower ASP, we're also going to see an increase in cash costs for that division. In 2013. Oh, and also because we're growing our volumes and we're close to capacity, we're going to need to invest more than what's reflected in depreciation. So as you can see, the depreciation and capex figures have been kept roughly the same as a percentage of your asset base. So let's make a more reasonable assumption and assume that this will be 17% instead of 13. So much more capital requirements and less cash available from operations because we're seeing a margin contraction and volume contraction. What else can we change? Let's assume cost of debt will be higher. Banks will look at the situation and will say, you know what, your business is getting riskier, so I'm going to charge you 100 basis points more. So instead of 7, it's going to be 8. Right? So our net income before all these changes, which is in the highlight here in yellow, was almost 10 billion. Shareholders' equity, 48.9 billion. Okay. We had a surplus to repaying debt for the previous scenario, 2.2 billion. And so if we look at the balance sheet, we're seeing a decrease in that, right? Now I'm going to press F9, and everything is going to run through. So not only 2013 changes, but because everything is connected, all my my starting point changes, so the future also changes. So now my net income is, instead of almost 10 billion, it decreased by almost 40%. My balance sheet is not decreasing that, it's actually increasing a little bit. And my shareholders' equity is not growing as much. And instead of having a surplus and repaying 2 billion in debt, I'm actually having to ask for 384 additional loans, which is what's being reflected in the balance sheet. And as you can see in the balance sheet, my balance sheet balances all perfectly, because everything is interconnected. Now we're gonna undo all the changes. And recalculate, and we have again our surplus. So that's one thing you can do with your predictions. You can start playing with your assumptions or run a sensitivity analysis. If you're too optimistic, maybe you want to be more conservative, or if things have changed. You've made your best assumption, but a month from now things change, you change your assumptions and everything changes and everything is interconnected. you're connecting your operations, volumes and prices, your cost structure with your financials. Everything is tied in and everything connects in. The other thing that I wanted to show you is this. This is part of the analytical part of the process. One is the mechanical part, building your financials and your projections. What we saw in the last hour or so. The other thing that you can do is run an analysis. And in this case we have both historicals and projected figures. And I'm separating in the main items that you want to analyze in any project or in any financial case, analyzing a company for instance. You want to analyze growth, margins, leverage ratios, working capital, profitability, and valuation. Growth, we have the main items that we want to look at. Top line, revenue growth, what's happening in the past, what's happening in the future. Operating income, EBITDA net income, and earnings per share. In the case of earnings per share, there's one thing that we didn't cover, but if there's, for instance, if the balance sheet is already spread, let's look at that example. Net debt to EBITDA, looking at the leverage ratios. In 2008 was 4 times. Typically, a company that is 3.5 and above times would be considered as highly leveraged. The balance sheet is much more riskier. Your cost of financing will be typically higher, and you're much more constrained. You want to be very careful because if you have a deficit projected in those conditions with that starting balance sheet, you are running a risk of either not having enough cash available to fund your operations. And if that's the case, if no one, you cannot find banks, or you cannot go to the markets to issue bonds, then you're going to be forced to issue equity, typically in unfavorable conditions. And if you do that, if you issue equity at unfavorable conditions to continue to fund your operations because you're starting with a very leveraged balance sheet, you will end up diluting your earnings per share number. What you want to see is that your earnings per share number, this line here, grows on a consistent basis. You want to see this growing year over year. If in your projections you're assuming that you cannot raise more debt because you have a limit, maybe 3.5 or 4 times like EBITDA, then you need to go back to your cash flow, consider that you're going to increase equity rather than debt, and then your earnings per share will be diluted. So those are the things that are very important to keep in mind, and one of the reasons why it's important to keep everything interconnected, so that one thing leads to another. There's a logical connection between the different parts. The other thing that you want to look at is the trends. When you're projecting, you don't want to be optimistic and you don't want to be too conservative. You just want to be realistic. In many cases, when a company is trying to sell you a project, you will see projections that are very optimistic. And maybe if you select the revenue line here, and what I'm going to do is I'm going to generate a chart, and then insert a line chart. So the growth rate of revenues is really not doing much. To be more aggressive. If we're going, let's say, we go back here to our projections, and we assume something very favorable, something like growing 50% per year, year after year. So that has an effect on growth rate. So 30%. Now your growth is much more at a much higher level. You want to see this trend analysis and see where it's been in the past to have a better sense of why your projections make sense or not. In this case, this is a very cyclical business, so you want to be very careful. You want to be on the conservative side and keep your growth rates outside. Okay. So that's for growth. Margins, it's the same thing here. You have much higher margins in the past than in the future. Because this is is a result of your assumptions, this is also a cross-check. You can check whatever you had in your inputs and your assumptions. This is a cross-reference point where you can see whether or not those make sense. Leverage ratios, net debt to EBITDA, divided by interest expense, and net debt to equity. Those are the three typical ratios that we want to analyze. Working capital. In addition to the three line items that we already described, you have net working capital as a percentage of revenues. If this is decreasing, it means that the company is more efficient, it's better. If it's increasing, it's a yellow or red flag. Profitability ratios, these are very important. Return on equity. Return on equity is simply your net income divided by your book value of equity. So it's a measure of how much you're growing your equity on a recurring basis in your operations. Return on assets is net income divided by total assets on your balance sheet. The adjusted return on invested capital, this takes into account the investments in working capital and capex. And this line here is the growth in return on equity, so it's the change in growth. So it's a derivative of ROE. And these are very important because these are valuation drivers, and that's the next step. The next step is valuations. We have a number of ways of assessing value. One is valuation multiple. You will see here, this is a publicly traded company, they're called publicly traded companies, and you can also use public information as a comparative basis to assign those multiples to private companies or to individual projects. Typical ratios that we look here, valuation is price to sales, EV to EBITDA, price to cash earnings, price to earnings, price to growth, free cash flow yield, and price to earnings growth. The reason why this is important is because there's a direct correlation between ROE, profitability, and valuation premiums. The higher the ROE, the higher the valuation premiums, and vice versa.
Just a quick question.
Yes.
How do you put in the X? So whenever it's a number. Yeah.
So what you do here is go to select the field, in this case the cell. You go to format cells, and then number, custom, and you can type in here as a 0.0x, and that will give you one decimal or an X. So you can do a 1 or 1. So it has to be 0.0x. And finally, this is the final part of this, is the cash flows analysis in the form of the DCF. I'm sure we've covered this in the materials with Russell Ross. But one tool that you have to evaluate cash flows for a corporation and to assess how much that company, corporation, or project is worth is through the discounted cash flow methodology. And what we're doing is for the projected period, we're taking the net cash flows. In this case, we're starting with EBITDA rather than net income. That's the same concept. It's cash flows to the enterprise. EBITDA, taxes, investments in working capital, and capex. We derive a net cash flow for each of the projected years. And with a discount rate, that in this case is 11%. So this will be the rate in your NPV formula, for instance. You can calculate your net present value of those expected cash flows. And with those, you can calculate all these figures that indicate you with a sensitivity to the perpetuity growth rate, in this case from 2.5 to 4.5, and a sensitivity to the discount rate from 12 to 10 with a central point of 11, how much the company is worth based on its cash flows. So you have a total enterprise value. The total enterprise value, you deduct the debt, the net debt, and with that you calculate the equity value. And you can compare the net equity value with the market cap, the market valuations, and you can make assessments of whether or not this is an attractive investment and it's being discounted by the market. So you can buy at a discount, expecting it to appreciate over time. That's a good one. That's it for today.
So next
Well, next time we're gonna do an actual example. So we're gonna work step by step. So today I gave you the mechanics. I showed you how it's done. Next session we're gonna do an actual example from the looking at the historicals, analyzing the variables, determining the drivers, and just applying that logical sequence and building our spreadsheet from scratch. So it's going to be a practical session. And after that, you should be able to do the term planning. And that's going to be the term planning session. Very good? Well, the main purpose of the class today was to show you how to apply the main functions in Excel, number one. Number two, how to create an Excel spreadsheet, or take an Excel spreadsheet from scratch and build financials, so the 3 financial statements, and then taking the historical financial statements, identifying the key drivers and using those drivers to calculate the projections. And finally, how to use those projections to tie in the 3 financial statements so that everything works in sync. And then you can write the ratios page and the ratios analysis of the discount calculations.
Which ones do you recommend just to focus on for the next session so we practice them? Which ones, like for example, min, max,
well, my suggestion is that you study in detail how the spreadsheet was built. So we're going to do this from scratch. We're not going to have a full model in front of us. Study this section here. All the calculations used for the balance sheet and cash flow. This part here. Really understand what these 2 formulas mean. And try to connect what you've seen in the class. I mean, you've covered the basics of financial statements and how to evaluate projects. Try to connect that to this example. So at the next session, you can start building from scratch one example.
A question about the projections sheet. We're talking about revenue projections and how those conglomerates the drivers are. It's a function of the type of pieces. I was looking like across different industries. Again, this would be drivers. In all likelihood, be pretty uniform by business type amongst analysts, or do analysts have a wide variety of opinions on what constitutes like an actual important drivers for each?
No, each industry has its own drivers, so we would expect that all the industry analysts that in that industry or that cover that company have the same method. It's very, I mean, you know which are the key drivers. The telecoms is very different than for industrial.
There's no like diversity of opinion on what actually is important, like that's people agree on.
I think in my experience, what's important is to identify the lowest level, the most simple level, so that you start aggregating from the very base. It has to be the most basic variables. That's what we identify. Other questions or comments? I have one question. Is this tie in well with what you've seen with Vault in the last 6 or 7 sessions?
More or less.
More or less?
We've been looking at like very simple balance sheets. But it's interesting to see a balance sheet that could exist in the real world. Yeah, I thought it was very, very happy.
Well, yeah, this is, as you said, this is a real live balance sheet that I'm going to show you here. But at the same time, what I'm trying to do is to just focus on the key line items that will allow me to analyze the company, understand the balance sheet, leverage, potential for the future, and that I can project those lines accordingly. Those are things that I in this case.
Out of curiosity, you said you got this from Bloomberg. Is that something the public can go on and download?
No.
No.
No, these 2 sheets here, this is what I get from
It's because the ticker's there and it can accommodate any.
Yeah. I just changed the ticker. I mean, you need to be connected to it, you need to have a service.
So you will give us those two tables next session and we start from there?
No, we're gonna start from scratch. I'm gonna give you the basic financials without the drivers, so that we spend time thinking through, let's analyze this company, let's figure out which are the key drivers, and we'll build them here, live. So I'll give you the basics, but not everything I've already done for next session. Are there any other topics that you'd like to cover or to like to go over now or next session?
We just have to try it and see what questions come up as we go.
Okay.
One question, you mentioned we have to make sure that our Excel is set up to allow for iterative calculations. Are there any other pre-settings we should make sure we have set before we go to the next session?
I think that in some of my models there are historical macros that I built in. They're not needed anymore, so if it shows you a message changes, cancel or say okay,
Okay.
yeah, so we don't need anything else than what we saw here. Alright guys, so I hope that was helpful.
Thank you.
Yeah, thank you.
Thank you.